Hey, I'm Jay from ClearHouse. If you've been following the Toronto housing market over the past few years, you've probably felt the emotional whiplash. We went from record-breaking prices to aggressive rate hikes to bidding wars disappearing almost overnight. And ever since then, there's been one question sitting in the background. Where are we actually in this cycle? Some people think the worst is over, some think another drop is coming, and almost everyone is wondering the same thing. Has the market bottomed out? Today I want to walk through what the data is actually showing. Not headlines, not opinions, just numbers. And then we're going to tackle the bigger conversation that's dominating 2026. Is Toronto actually affordable again? By the end of this video, you'll understand where pricing really sits relative to the peak, why activity and prices don't move together, what bottoming actually looks like in real estate, and whether the affordability today is real or relative. Let's get into it. So, has the market bottomed out? The simple answer, no, it hasn't. But instead of just saying that, let's walk through what the numbers are actually telling us. At the peak, the GTA benchmark price was just shy of $1.3 million. Today, we're sitting at around $935,000. That's a meaningful correction. When interest rates first started rising, prices dropped quickly, especially in that first 6 to 8 months. Then in early 2023, something interesting happened. The market started to rebound. Why? Because the Bank of Canada signaled a pause in interest rate hikes. Buyers stepped back in, confidence improved, prices climbed, but that momentum didn't last long. 2 additional rate increases that summer cooled things down again, and since then, we've seen a gradual downward drift in pricing. Not dramatic, not chaotic, just slow, steady softness. And that's the key point. Market bottom usually looks like prices flattening out and moving sideways for a sustained period of time. We haven't seen that yet. We're still trending slightly downward. If you zoom out even further, today's overall pricing is roughly back to early 2021 levels, and condos in many cases are back to 2019 pricing. So no, we haven't bottomed. And transaction volume may improve this year. Activity often returns before pricing does, but buyers aren't focused on volume, they're focused on price. They're asking, if I buy now, could prices still fall? And the honest answer is yes, they could. And that's why time horizon matters. If you're planning to sell in 2 years, buying probably doesn't make sense. Renting is the safer option. But if you're thinking 5 years or longer, short-term price movements become far less important. For sellers, the message is just as important. Waiting isn't necessarily a strategy that gets you a higher price in 2026. You might see more activity during peak seasons, but activity and price are not the same thing. Today's market requires realistic pricing that aligns with what buyers are actually willing to pay, not just what the marketing suggests. And that brings us to one of the most overused and misunderstood words in Toronto real estate right now, affordability. If you type Toronto real estate into Google today, you'll see headlines like home prices are down 27%. Buyers jump into Canada's housing market. Canada sees the largest home price decline among major economies. Every headline suggests the same thing. Prices are down and affordability is back. But instead of debating the word affordable in theory, today I want to show you a real example with real numbers and then ask the bigger question. Is Toronto actually affordable in 2026? The property I want to use as an example today is in XO Condos, specifically 270 Dufferin Street. The building is a part of a 2-building complex that also includes 285 Dufferin Street. It's a high-rise 14-story building completed in 2023. It's a modern open-concept design that comes with 10-foot ceilings, a designer kitchen with an island, floor-to-ceiling windows, and a large private balcony. And the location? You're just minutes from the waterfront, steps from Exhibition Place, and in the heart of Liberty Village, King West, and Queen West. It's a great building in a great pocket of downtown. The unit I'm referencing is 564 square feet. It's a 1-bedroom plus den with 1 bathroom, has parking and a locker, and it sold in November for $400,000. Now let's run the numbers. Now let's assume a realistic first-time buyer scenario. 10% down, 30-year amortization, 3.99% interest rate. Here's what that looks like. It comes out to a $40,000 down payment, $1,709 per month mortgage, $593 per month in condo fees, $272 per month in property taxes. The total monthly carrying cost comes out to about $2,570 per month. The same unit will likely rent for around $2,300 per month. So at first glance, renting looks cheaper, but here's the part that people often ignore. About $577 per month of that mortgage payment is principal repayment. That's forced savings. That money isn't disappearing, it's building equity. If you subtract that principal repayment, the net cost of ownership is about $1,997 per month. That's actually lower than renting. And yes, ownership comes with risk. If prices drop, leverage works against you. With 10% down, you're leveraged 10 to 1. But leverage cuts both ways, and we're not going to turn this into a prediction video. The point here is math. Even without assuming appreciation, ownership today compares very differently than it did a few years ago. Let's rewind the clock. Not long ago, this same unit would have sold for about $600,000. Now let's run those numbers. At $600,000, you're looking at $60,000 down, same amortization, but at today's 3.99% rate. Your monthly cost would have worked out to roughly $3,429. Now let's correct that properly. Back then, interest rates weren't 3.99%. The Bank of Canada had rates much higher. Let's assume a 5.5% mortgage rate. Now that monthly cost jumps to roughly $3,910 per month. So compare that $3,910 per month a little over 2 years ago to $2,574 per month today. That's a massive difference. By any measurable definition, the condo is more affordable today than it was. But that leads to a bigger question. What does affordable actually mean? The federal government defines housing as affordable if it costs less than 30% of a household's gross income. So if the condo costs $2,574 per month, that means you need to earn about $102,960 per year to meet that 30% definition as an individual. But here's the thing. Most lenders don't use 30%, they use gross debt service, GDS, which is typically capped at around 39%. At 39%, you'd need an income of $79,200 per year to qualify. Now ask yourself, is it unreasonable to expect someone buying a condo in downtown Toronto in 2026 to earn $74,000 per year? Maybe for some people, yes. But for many full-time professionals working downtown, not unrealistic. And remember, if that income doesn't work, the same unit rents for $2,300 a month. That requires about $70,000 in income at 39%. And if that still doesn't work, there are options. Split a 2-bedroom, move slightly outside of the core, trade space for price. Affordability isn't just about the numbers, it's about expectations. Let's say someone works near the financial district and rents a 1-bedroom for $2,300 per month, earning $70,000 per year. They say Toronto's unaffordable. But is the city unaffordable, or is that specific lifestyle? What if they rented farther east? What if they had a roommate? What if they had optimized for savings instead of walkability? Affordability is partly math and partly choices. 2 years ago, rents were higher. 2 years ago, this condo was $200,000 more expensive. 2 years ago, interest rates were higher. Objectively, conditions have improved. So is Toronto affordable in 2026? Here's the honest answer. Toronto is more affordable than it was. That's not opinion, that's math. Prices are down, rates are down, monthly carrying costs are down, rents have softened. But whether Toronto is affordable depends on your income, your expectations, your lifestyle, and your willingness to compromise. Housing in a world-class city was never meant to fall under the government's subsidized definition of affordable across the board. Market housing is just that, market housing. The real shift in 2026 isn't that Toronto is suddenly cheap, it's that the pressure has eased. Buyers have options again, renters have negotiating power again, and the gap between peak pricing and today is meaningful. Affordability hasn't magically appeared, but relative to where we were, it's back. If you want me to break down a specific building, neighborhood, or price point, drop it in the comments. My team and I are always happy to run the numbers. Thanks for watching, and I'll see you in the next one.